How do you know when you're having a trending day versus a non-trending? And this is a difficult question to answer. I don't really always know. But I can tell you pretty well after it starts trading what should happen. And that's why this type of information is valuable to you, because if you know that most of the time there's a trend between, say, 9:30 a.m. East Coast time and 10:30 a.m. East Coast time, and it doesn't come then, you have to either push it back because later in the morning because it should come in. And you need to know these things to help you trade. I mentioned this, that each day is time specific. The number will vary from day to day, and you have to let the market tell you. Again, on any given day, you don't know what's going to happen. But the important thing is you don't have to know in advance what's going to happen. You have to know how to read the market and how to trade. When you read the market, you look at how it behaves, you do the measurements, you're always calculating, you're looking at indicators, and then you say, I think I see a pattern here, I think it's going to do this based on this, and then it's just a question of, over time, the probability should work out for you. And if it doesn't, if you get in the trade, if it goes negative on you, you take the loss and you forget about it and it's over with. As opposed to staying with it, letting it get worse. I don't think I've ever seen a trade that went against me that ever got better. They almost always get worse. So you have to be flexible and quick and not wedded to any position. If you want to see some good symmetry, turn to page 159. Here you have 600 points in 21 minutes straight up in the afternoon on a 1-minute chart. At the top, you see 600 points in 21 minutes straight down, and where does it stop? Right where it started from. This is the inverted V pattern, and it's just a work of art to people who study these patterns. So that's what I mean about symmetry. It's there, and you just have to be able to identify it and follow what it's telling you. I think I hinted at Rule 33 earlier in the presentation here, but I want to go over it again, and that's look for time and price velocity to speed up in the afternoon. What will happen in the afternoon as we approach the close is that everything tends to speed up by a factor of 2. So if it took 30 minutes to rally 400 points in the morning, it'll go 400 points in 20 minutes in the afternoon. It's as if everything becomes faster and faster as you approach the close. And on a trending day, what you'll find is that one side will predominate. In other words, if it's going up, it'll become more bullish at the end. It'll often make the high of the day, indeed, at the final 1 minute, which is why I love MOC orders, market on close orders. And the reason for this is, in my opinion, is that hope springs eternal in the futures market, so that the people who were sellers earlier in the day are not willing to get out until the end when they realize they have no place to go. They'll rush in as buyers and push it up even more. And you see this again and again. The sellers think, okay, I can get out of this on a break in the close. There is no break, or their brokers call them and say, we're getting you out at the close because it may go 1,000 higher on the open tomorrow. So what happens is, as it gets closer and closer to the close, you get these wonderful, strong, pure moves right into the close. And that's why I like MOC orders. MOC orders are always filled. If you have a bigger order, say a 10 lot or something, you can often get the floor to give you the edge. Why? Because there's a floor trader that's on the wrong side, and he's got to get out at 10, and the market's going to close in 30 seconds. He's not going to look around for a 1-lot guy. He's going to look for your 10-lot order, and he's going to give you the edge. And this is the only time I find where the fills can really be good, is when the other side's panicking and they're giving their money to you, anything to get out, and you have the right side. Of course, if you're on the wrong side, it works the other way, and anyone who's traded for a while, knows how that works. You're short, and you think, well, I'll get out on the close, there'll be a slight dip, and it won't happen, and then there'll be panic buying, and you'll have to join them at the end, pushing it up to the highs. And I talk about that on the herd instinct. And here it is again, the velocity tends to speed up by a factor of 2 or decrease by 50%. It often goes that way in terms of leg 1 and leg 2 as well. It'll be 10 minutes on the first leg and 5 minutes on the second, or reversed. 5 minutes on the first leg and 10 minutes on the second. In other words, it goes there real fast initially, sells off into the consolidation, makes the equilibrium, and then it takes a little longer, but it ultimately gets there. And here again on 163, I talk about that. The velocity on the first and second legs can differ by a factor of 2 or 50% reduction. The first leg of 7 minutes takes 14 on the second, or the first leg of 14 takes only 7. But look at the numbers in terms of that factor of 2. 14 divided by 2 is 7, 18 divided by 2 is 9, 10 divided by 2 is 5, and so on. And you'll see this symmetry coming up again and again. On 164, we've got the V pattern, but what you'll notice is the morning and afternoon trend are different in time, but similar in price. So you have an hour and 15 minutes down in the morning. It seems to want to take its time to go 880 points. But in the afternoon, in less than half that time, in 30 minutes, it goes 990. So it retraces the whole day's move, goes into new high ground at the end, and it does it much quicker. Another reason I tend to like the afternoon trade, but I have to stress this as well. There are times in the market when the afternoon trend is pure and simple and uncomplicated. Other times, the good trend will occur in the morning, and this will shift over time. So I don't want you to go away from looking at this saying, George says the afternoon trend is the best. At certain times, it's the best. There are certain months, certain weeks when the afternoon pattern will be the best. But that doesn't mean that can't all shift and it'll go back to the morning. It will go back and forth is the actual fact. Rule 34, again, I alluded to this earlier when I said that there's a high probability that the highs and lows are made in the first hour and in the last hour. And that is look for an extreme end of the range in the final hour. There's a high degree of probability that either the high or low would be made in the final hour, even in the final minute on a trend day. And I've seen this repeatedly as well. There was a time earlier this year where late in the day you could buy breaks and almost always make money. And the people who were doing that and making money, I remember talking to a few of them and saying, you keep doing that, you'll be in trouble, because what's happened is the market's become, it's changed in the sense that there is follow through to the downside now. So if you get a leg down, don't try to buy that leg in hopes there's not going to be a second leg, because now there will be a second leg. And if you try buying those steep breaks, you'll get in a lot of trouble, because anyone who trades the S&P knows that these downside breaks can be really treacherous, because it just goes straight down when that happens. And so in Rule 34, I talk about being prepared to trade the market into the final 10 or 20 minutes. I've had trades I've taken as late as 10 minutes before the close to get out of the close, because I realized we had a pure move into the close coming up. And sometimes those can be big money makers. Just make sure, though, if you're day trading, you got the MOC order, and don't wait till the final minute to put in the MOC order for fear they don't pick up or they can't get the order in. I put in my MOC order about 5 or 6 minutes after 4 o'clock on the East Coast, about 9 or 10 minutes before the close, because that's the time when I've got a pretty good handle on whether it's going to go up or down and whether I'm willing to risk going into the close with the position. And I'm not always right, of course, but most of the time I get an improvement on the price. Now, speaking of going into the close, another thing I want you to be aware of is this Rule 35, which is coming up right now, and that has to do with fade any persistent pattern that works 2 or 3 days consistently. Here again, people want to make hard and fast rules based on little evidence. What you'll see is the market will break day 1, it'll break day 2, maybe even break day 3 going into the close. So that's not a clue for you to say, you know, every day it sells off into the close, I think I'll be a seller into the close. No, what'll happen then is when it becomes too predictable, too pat, you have to think in terms of the perversity of the market and say, this time it won't go down into the close, and it will indeed rally into the close. You'd be surprised how that can keep you out of trouble, because if you get the same pattern over and over, it just won't work consistently. And I mentioned here that this could be a rally into the close, a gap being filled, or a noontime break. Any of these patterns that become too predictable won't continue to work. The market is not going to make it that easy for you. Once it becomes too predictable, it won't work. So if the market tends to sell off in the final hour or to rally into the close, or on 2 or 3 days running sell it, it will probably close on the low of the day. And I've been able to do that for that precise reason. On Rule 36, we have be very patient but move quickly. And by this, I mean you really have to sit down with yourself and say, you know, I want to be a day trader. I want to trade time and price. I want to do it the proper way so I don't have all these regrets about the way I trade, like, you know, I let the market get away from me, I put the stop too far away, I held on too long, or I got out too early, or whatever. So what you need to do is before the market opens, you have to sit down and say to yourself, when the time comes to take this trade, I'm going to do it, win or lose. And then I'm going to trade the way I've told myself I'm going to trade. I'm going to trade intelligently. I'm not going to let the losses get away from me. I'm going to let the patterns develop. I'm going to let the market tell me what to do, and then do it. That way, win or lose, you can say, I gave it my best. I didn't do anything stupid. See, people make what I call stupid mistakes versus intelligent mistakes. You're always going to make intelligent mistakes in the market. But it's what I call the stupid mistakes that kill people. They let the losses grow too big, and they can't come back from that. You know, they overtrade, they do 7 lots and lose, and then they try to make it back on 1 lot, and it's not going to work. You have to trade in an intelligent manner, and you have to do the things that over time will make you money. And that's why I stress this importance of your own personal psychology. I think I can make you a better trader, but I don't think I can really make you a good trader if you're not cut out to do it. And you have to be the one who brings the temperament to the table where you can pick up the phone and trade the way you want to be. Usually I can talk to someone and see right away by what they're doing, or I ask them what they're doing, if they're making mistakes to see what they are. And there's a lot of senseless mistakes that people make in the market that they shouldn't do.